Hey Trade Pros, this is Mark from Trade Pro Academy, and in this weekend's video, we're going to answer one of the common questions we get from newer traders, and that question is, what are the key differences between day trading and swing trading, and which one is right for me and my current situation? So before we get into the actual presentation, if this is your first time on our channel, welcome. If you're a returning viewer and a subscriber, thanks for coming back. For all of you guys who aren't currently subscribed, please make sure to go ahead and subscribe to the channel and make sure to check off that notification bell so that you guys can get updated anytime that we go live or anytime we drop any new content. In addition to that, if at any point in this video you guys enjoy what you're hearing, what we're putting out, please make sure to go ahead and smash that like button. That's really going to help us out with the YouTube algorithm and get us in front of other traders like yourself. So with that out of the way, let's go ahead into the meat and potatoes of this presentation. All right, Trade Pros. So now that you've gone ahead and subscribed to the channel and liked this video, let's go ahead and get started with this presentation. What you guys will see in front of you is a little grid that we've gone ahead and put together with regards to some of the key factors that are different between the day trading style and the swing trading style. And these factors are the holding period, the trade frequency, the commitment, the time commitment required for each style, the risks associated with both styles, some of the costs associated with them, the profit potential, and the personality type. This is basically what type of personality is best suited for each style of strategy. All right, so without further ado, let's go ahead and get started with the first one here, that being the holding period. So as a day trader, as the name would imply, you're looking to get in and out of trades in the same day. Your holding period is intraday. What that means is you start the session in cash and you try to end the session in cash, ideally with more in the account than what you started the day with. That's really the whole purpose of day trading. It's to make consistent income, to make consistent cash flow. And as a result of this style of trading, the holding period will be anywhere from a couple of seconds to a couple of minutes, can even go up to an hour or two, but your holding period will generally be under 6 hours, which is typically a trading session. All right, so as a day trader, you're going to be holding and getting rid of those positions intraday, whereas as a swing trader, you're going to be holding trades anywhere from 1 day up to several weeks. All right, so as a swing trader, you're generally looking for larger moves, whereas a day trader is looking for intraday moves. A swing trader will be looking for a longer term kind of a movement. And as such, the trades will take a little bit more time to develop and play out. And that's why the holding period is a little bit longer than a day trader, that being an overnight hold up to several weeks. All right, so swing traders, as you guys can see from this first example here, these guys are a bit more passive in their approach. They're not getting in as many times, and that's because they're looking for larger positions. All right. That drives us right into the next point as far as trade frequency. Okay, so trade frequency is simply how many positions you're going to be taking on a daily basis, on a monthly basis. And as again, the name would imply, a day trader is going to have more trades than a swing trader on a daily basis and also on a monthly basis. So for day traders, they can make anywhere from 5 to even 100 trades per day. You know, our community here, we try to focus on 5 max a day. All right, most of our traders will be in the neighborhood of 3 to 5 trades a day. The higher end tends to be scalpers and higher frequency traders. They can do, 50, 100, a couple hundred of trades on a single session. All right, and so day traders, the main difference between the two is that day traders, they're able to take this many positions because they're generally looking for smaller moves. They're looking for smaller price fluctuations to capitalize on. And as a result, their risk reward profile also tends to be a little bit tight. What that means is a risk reward profile of say 1.5 to 1 or even 1 to 1 is quite common for day trading strategies. And what that means is for every dollar that you're risking, you're looking to make $1.50, to $2. In the case where it's 1 to 1, you're looking to make $1 while you're risking $1. So day trading strategies tend to be a little bit of a higher strike rate, meaning you're going to be right more times than not. And as a result of a higher strike rate, you'll likely have a lower risk reward profile. And being able to catch multiple small price fluctuations on a daily basis is what this strategy is all about. So 5 to 100, you won't necessarily be going towards this side. You'll be leaning more towards the lower end of that side as a day trader. All right. Whereas a swing trader, because they're looking for larger moves and because their holding period tends to be longer, they're going to have less trades on a monthly basis. A swing trader, when trading their strategy and filtering out the non-quality setups, will have anywhere from 5 to 10 trades on a monthly basis. And again, this kind of drives back towards the risk reward profile of these because they have less trades on a monthly basis and they're looking for larger moves than day traders are. Swing trading risk reward profiles tend to favor higher risk reward, which also means a lower strike rate. So while swing trading strategies tend to have a lower strike rate, meaning you're going to win less than you're going to be, rather, you're going to be losing more often than you're going to be winning, which is okay because the risk reward profile tends to be most commonly 3 to 1, which means that a swing trader will often risk $1 to make $3 gain. All right, so you guys can see, whereas day traders, they're looking to capture smaller moves, they're looking to get a higher strike rate, and they're looking to use a lower risk reward profile. Whereas a swing trader, they're going to be looking to take less trades for bigger moves, so their risk reward profile is going to be greater, and that means that their strike rate is often going to be lower than that of a day trader. All right, so let's move on to the time commitment here. So time commitment for a day trader is minimum 2 hours a day. No ifs, ands, or buts. The reason why you need minimum 2 hours a day is because you need time in front of the screens to scout for opportunities. You need to take those opportunities. You need to manage those trades while you're in them. All right, and you've got to keep scanning for more opportunities. So it's a rinse and repeat kind of a cycle, and it's going to take at least 2 hours a day. And you know, our community here, we like to trade 2 hours ourselves. We like to trade the US cash open into the European cash close, 9:30 a.m. till around 11:30 a.m. Eastern time as well. So minimum 2 hours a day. Some day traders like to trade from open to close, 9:30 a.m. To 4 p.m. That's not necessary. You can still make a full-time income with only 2 hours a day, but your time commitment, you're going to need to have those hours in front of the screen. So this is something that's more applicable if you have the freedom of schedule, you have flexibility in your schedule to sit in front of the screen for those 2 hours of the session for at least the cash open. Right? If you have that time flexibility, or you want to do this full time, you're going to need to have those hours available in order to do that successfully. Whereas a swing trader, they'll only really require, you know, 30 minutes a day minimum to trade that strategy successfully. And the reason for that is because a majority of your analysis for swing trading for the week going forward can be done on the weekend when the market is closed. So when the market opens up for the coming week, a swing trader will just keep an eye on, you know, the pairs that they're watching or the stocks that they're watching, and they're going to set their orders, see what gets triggered, what doesn't get triggered, and all they really need in those 30 minutes is to place new orders and to manage existing orders. So you're not really looking for too much. A majority of your opportunities, you already know what you're looking for before the market even opens. So throughout the week, you're going to need maybe 30 minutes just to update those orders and to set new ones. So the time commitment, as you guys can see, as a swing trader, it's a lot more passive than day trading. And what that means is that if you hold a full-time job, a 9 to 5, and you're not able to sit in front of the screen for those at least 2 hours a day, swing trading is a viable alternative for you to still be active in the industry, you know, while adjusting to your schedule, while making the market work within your actual schedule. All right, so that is the time commitment between these two strategies. As far as risks are associated, for day trading, the main risk associated with day trading is daily volatility. And what I mean by this is that daily volatility is important for day traders. Day traders love volatility, but volatility is double-edged sword. All right. If there's no volatility in the markets on a certain day, you're not going to be as aggressive, not trying to make daily profits, not trying to get the full daily profit at least. Whereas if there's good volatility, you've got an opportunity to make your daily profits and then some. All right. That being said, since 2016, since Trump was elected, he's been very vocal on Twitter, and what that's resulted in is some unexpected volatility. So day traders love volatility. That's to be expected. And what I mean by that is when you've got events such as FOMC, such as NFP, anything that's high impact like that, that's scheduled where you're anticipating volatility to come into the markets as a result of that scheduled event, that's great. But with Trump and with his, the Twitter fingers, what can happen these days is, Trump can go in, say something, all of a sudden, market whips up or market shoots lower. And let's say you're qualified to trade, let's say you're in a trade long, and then Trump goes ahead and tweets out that he's canceled talks with President Xi with regards to the U.S.-China trade war. All right, market's going to dump. You're going to get stopped out of that trade, and there's nothing really you can do about that. All right, and so that's one of the risks associated with day trading, that daily volatility. Whereas with swing trading, the risks aren't so much in the daily volatility, they're more so in overnight and weekend gaps. And so this isn't something that you often see in markets that trade throughout the week, such as futures, such as Forex, such as commodities. But this is something that you'll often see if you trade stocks or if you swing trade ETFs, where the market closes throughout the week and then reopens the next day, right? You can be exposed to overnight gap risk. And so what overnight gap risk means is simply that when the market closes, let's say that you're long, let's say Facebook, you're long Facebook, and then as the market's closed, there's a big report that drops, such as the Cambridge Analytica scandal, right? Where it's a negative report, it's a very negative report, right? And what's likely to happen is the next morning when the stock market opens up, that stock's likely going to gap down lower, right? And so if you were long that stock before the market closed, on the market open, when it gaps down, it doesn't matter whether your stop is, up there. Here it is. It doesn't matter whether your stop's up here, because the market's gapped down, you're going to get taken out at that lower price. You're not going to get taken out at your stop loss. All right. So that's one of the risks associated with swing trading stocks and ETFs, is that overnight gap risk. That being said, there is also weekend gap risk. So those traders that are in Forex, commodities, and even futures, they are not immune to this kind of a risk. And a good case in point is the crude oil gap that happened about 2 weeks ago now, when the Saudi Arabian oil field was bombed by some drones, which took out a good chunk of production, a good chunk of supply from the oil markets. And what happened as a result of that is when the futures opened up on Sunday morning, the crude gap 10%. All right, so 10% gap up from Friday's sessions close. So if you were short into Friday and Sunday happened, Sunday opened, and the futures gapped up, again, you're not going to have your stop loss honored because there's no traded volume out there. Everything's gapped up. So you're going to take a larger loss than anticipated. And that's one of the risks associated with swing trading, is that overnight and that weekend gap risk. All right, so now let's drive down to the costs. And as you guys can see on here, the costs associated with day trading are more expensive than swing trading. And the reason for this is because day trading software, the software used by day traders, is a lot more sophisticated than what swing traders need. A lot of day traders utilize order flow tools, which means that you need advanced order flow packages. A lot of day traders also require new squawks, which means you got to subscribe to a new squawk. All right, so all of these things combined can add up to quite a lot. And another thing that will add up is also commissions. So as you guys can see on the frequency tab over here, 5 to 100 trades per day, will add up. the more trades you're taking, the more commissions you're paying, and the higher your costs increase. All right. So as far as a software perspective, day trading is more expensive. And as far as a commission, cost of doing business perspective, day trading is also more expensive because you're going to be taking more trades. Whereas with swing trading, the costs as far as software is concerned is less expensive because you don't need as sophisticated a tool as you do for day trading. Right? With swing trading, all you really need is candlestick charts, simple software package that can offer candlestick charts, volume profile, regular volume, moving averages, some indicators like that if you need those. But what swing traders need is a lot less intensive than what day traders need, which means it's cheaper. All right, so you can get away, you can rather get by with a nice software package that offers just regular charting. As long as you have a price chart, as long as you have volume and volume profile, that's really all you need as a swing trader in order to succeed. On top of that, because you're not taking as many trades on a monthly basis, instead of taking 5 to 100 a day, you're going to be taking around 5 to 10 a month. Okay, and so as a result of that, you're going to be paying less in commissions than you would as a day trader, making swing trading the less expensive option to start with. All right, so now let's get down to the profit potential. So as far as profit potential is concerned, it really depends on the actual trader. All right, day trading versus swing trading. If you have a crappy day trader and you have a good swing trader, obviously the swing trader is going to make more money. So this one is more reflective or relevant to the actual traders. But as far as compounding positions and the probability of doing so, that happens to favor the side of day trading. And the reason that is because you're going to be making more trades on a monthly basis as a day trader than you will as a swing trader. And what that means is that you're going to, by taking more trades, your edge has a better chance of playing out within the month than as a swing trader who's taking less trades. So what that means is even though your wins are going to be smaller than what a swing trader would be, targeting, because the frequency of your wins happens a lot more throughout the month than a swing trader, that compounding effect is going to take account a lot faster as a day trader. All right. Whereas a swing trader, you're still looking for profits. Swing traders will look for smaller moves, looking to make 5 to 10% on a position. All right. And as a result of that, the compounding is still there, but it comes at a slower pace than what you would see from a day trader. All right. And finally, into the last section of this presentation here, the personality type. So which personality type bodes well with each strategy? So as a day trader, you've got to be decisive, you've got to be patient, you've got to be diligent, and you've got to be mentally tough. All right. A day trader, if you're looking at personality A and personality B types, a day trader would be the personality A type. All right. These are the type of people that would be competitive. They tend to work well under pressure. They tend to be decisive under pressure. They're able to flip their bias on a dime. They're able to make split-second decisions. If this sounds like you, then day trading would likely be better suited towards your personality than a swing trader. Whereas for swing trading, what you would have is more reflective of a type B personality, which means you're a bit easier going. This isn't saying that you're not also patient, you're not also disciplined, right? You're not also diligent. You got to be all of those things, but a swing trader has a more easygoing, a more passive approach towards the markets. They don't really want to be in the situation where they got to make split-second decisions, right? If you take a loss on a swing trade, you've got time to look for other opportunities to set those trades. Whereas as a day trader, if you take that loss right away, you've got to be able to say, all right, is my bias still valid? If not, I got to flip my bias. I got to start looking for longs instead of shorts, etc. So the day trading personality is a lot more aggressive, if you will, than a swing trading personality. So depending on what type of personality you are, as we just mentioned, you'll either fit into the day trader or into the swing trader style of trading. So that being said, that basically concludes this presentation. with regards to the key differences between day trading and swing trading. I do hope that this presentation gave you a little bit more insight into the differences between the two strategies and helped you kind of define which one is better suited for you at this point in time. Now, that being said, what we often say is a good day trader will make a great swing trader, whereas a good swing trader doesn't necessarily mean that you're going to be a great day trader. All right. And the reason for this is because as a day trader, you're looking at the smallest price fluctuations, and as a swing trader, you're looking at larger price fluctuations. All right. So as you start, you can choose one of these styles to start with. All right. And then you can kind of mesh the two. And that's typically what we see is most people will start off as swing traders. As they get more experience in the markets, as they start making money, then they start venturing towards day trading. And the reason we like day trading is because you can essentially come from a swing trading background, get into day trading, and then you can start and take trades, starting them off as day trades, and then utilize your experience as a swing trader to extend those profit targets and take a day trade to start and extend that into a swing trading position. That is really where the money is made in these markets. If you can start off a day trade with very tight risk and take profit as if it was a swing trade, you know, um, that's going to be a lot more than a 3-to-1 kind of risk reward profile. So I hope you guys enjoyed this one. If you guys did, please make sure to go ahead and smash that like button, help us out with that YouTube algorithm, and make sure to subscribe again to the channel. Until next time, guys, good luck and good trading. Take care.